So imagine an Olympic athlete for a second. Not the sprinter who just dedicates their entire life to shaving, like 1/10 of a second off the 100-meter dash.
Right, or the weightlifter who only cares about the biomechanics of the clean and jerk.
Exactly. Picture the decathlete.
Oh yeah, the ones who just have to do everything.
Right. It's this rare, almost mythical competitor who has to be world-class in 10 completely different events. I mean, they have to master the explosive power of the shot put, the technical precision of the pole vault, and then somehow have the endurance for the 1,500-meter run.
Which is biologically and honestly, psychologically almost impossible to maintain at that level.
Exactly. And so if you take that concept, right, and apply it to the tech hardware market right now, you're looking at Garmin.
Yeah, that is a really perfect analogy.
Because they aren't just competing in a bunch of different events. They are actively winning the gold medal in totally disparate arenas simultaneously. I mean, they're dominating in wearable fitness tech. They're building integrated flight displays for aviation, pioneering marine sonar, embedding themselves in automotive OEM systems, and outfitting golfers with laser rangefinders.
It's the corporate decathlon.
It is.
Yep.
And based on the Q2 2026 earnings call that we are tearing into today, they're basically breaking world records while doing it.
Welcome to the Special Talk Tickers edition of the Deep Dive, by the way.
Yeah, glad to be here.
Our mission today is simple. We are taking the Wall Street jargon from Garmin's Q2 2026 earnings call and translating it into a fast-paced, data-forward, and totally actionable analysis for you, the retail investor. We're keeping this concise to respect your time, so let's just sprint right into it.
Let's do it because, you know, the corporate decathlon is notoriously dangerous.
Oh, absolutely.
Like most hardware companies that try to diversify that broadly, they end up just cannibalizing their own R&D budgets.
Right. They lose focus completely. Exactly. They get outflanked by some niche competitor in one of those verticals, and the whole structure just sort of collapses under its own weight.
Which is what makes this particular deep dive so critical, right?
Because Garmin is defying that gravity. We're looking at a company operating at just peak efficiency across multiple, highly complex, supply chain heavy sectors.
Right. So if you are holding this stock right now and wondering if this run has legs, or, you know, maybe you're sitting in cash looking for a resilient tech play in this crazy macro environment.
The mechanics of how they are achieving this are essential reading. We aren't just looking at the scoreboard today. We have to look at the biomechanics of the athlete.
I love that. But let's actually start with that scoreboard because the headline numbers just jump right off the page here.
They really do.
Q2 consolidated revenue hit $2.02 billion. That is an 11% increase year over year.
Which is wild in a hardware market where consumers are supposedly, pulling back on discretionary spending.
Yeah, double-digit top-line growth is a massive anomaly right now. But honestly, the top line isn't even the most impressive part.
Not at all.
Pro forma earnings per share, their EPS, came in at $2.81. That is a 29% increase from the prior year.
Yeah, so revenue is up 11%, but operating income surged 30% to $616 million.
Right. So getting 30% bottom line growth out of just 11% top line growth, I mean, that means they have incredible operating leverage.
Exactly. They are basically squeezing way more juice out of every single orange.
Right. And where do we see that leverage most clearly?
Oh, it's entirely visible in the margin expansion. I mean, on Wall Street, margins are the ultimate truth teller for a hardware company.
For sure.
So the transcript shows gross margins expanding by 360 basis points to 62.4%, and operating margins expanding by 440 basis points to 30.4%.
And just for anyone who might not live and breathe Wall Street jargon, a basis point is just 1/100 of a percent. Mm-hmm. So 440 basis points is 4.4 percentage points.
Right. And to put that in perspective, maintaining a 30% operating margin in physical consumer electronics is staggering.
It's almost unheard of.
Yeah, because you are subtracting the cost of materials,
yes.
Right? The titanium, the glass, the microchips.
Right, the physical stuff.
Then subtracting the assembly labor, the R&D, the global marketing budgets, the logistics, and you are still keeping more than 30 cents of pure operating profit for every dollar that comes in the door.
Yeah.
Expanding that by 4.4 percentage points in a single year shows just a ruthless level of operational discipline.
Okay, hold on. I have to interrupt you there.
Oh.
Because I read the exact same transcript.
Yeah.
And I saw a glaring asterisk next to those margin numbers.
The tariff refund.
Yes. Cliff Pemble, the CEO, explicitly mentioned a $21 million tariff refund that was recognized in this second quarter.
He did, yeah.
So, before we crown them the kings of operational discipline, we have to acknowledge that a massive check from the government for a tariff refund is going to fall straight to the bottom line, right?
Of course it is.
It dresses up the quarter, it makes the numbers look artificially amazing. So my question is this 440 basis point margin expansion just a one-off lottery ticket from the government, or is there actual fundamental strength here?
Well, so that is the natural skeptical reaction, right?
Right.
And you should have it. A $21 million injection of pure, unadulterated profit is absolutely going to juice the numbers.
Right.
And management was totally transparent about that. They noted that it heavily benefited the marine segment's reported margins specifically, but the math actually tells a different story when you isolate it.
Okay, break the math down for us.
So total revenue was $2.02 billion. $21 million is roughly 1% of that revenue.
Right.
So if we back out the equivalent of about 100 basis points for that tariff refund,
You are still looking at a 260 basis point organic expansion in gross margins.
exactly.
Wow. Okay, so you still have 2.6 percentage points of pure fundamental margin improvement that has absolutely nothing to do with a government refund check.
Which is exactly why management confidently stated on the call that even excluding the tariff benefit, their gross margin performance was impressive by literally any historical comparison.
Yeah, the narrative actually holds up to the math.
The tariff refund was a nice tailwind, sure, but it wasn't the engine. The actual engine driving this, according to the transcript, is what they call a highly favorable product mix.
Favorable product mix. That is one of those sterilized corporate phrases that can hide a lot of sins, right?
Oh, absolutely.
But in this case, it's pointing directly at the absolute juggernaut that is their fitness segment.
The crown jewel.
Yes, we are talking about a segment that generated a record $757 million in Q2. That is a 25% year-over-year increase.
$250 million in growth localized just in fitness in a single quarter.
It's wild. So why is that mix so favorable?
It's the compounding effect of the segment's profitability. So gross margins in fitness expanded to 64% and operating margins expanded to 37%. Yeah, so when your fastest growing, largest revenue segment also happens to carry your highest margins, it physically pulls the entire company's average profitability upward.
Right. As fitness becomes a larger and larger slice of the total Garmin pie, the whole pie just becomes richer.
I like to think of it as the steakhouse dynamic.
Oh, I like this. Go on.
So if a restaurant sells burgers at a 10% margin and dry-aged steaks at a 40% margin, right?
Yep.
And suddenly a massive wave of customers comes in and they are exclusively ordering the dry-aged steaks. The restaurant's overall profit margin skyrockets even if the total number of customers only went up a little bit.
Garmin is selling a lot more steaks.
Exactly. And what's driving that demand is super fascinating to me.
It's the new hardware, right? They rolled out the Forerunner 70 and the Forerunner 170.
Yeah, but the crucial technological leap here is the broader adoption of AMOLED displays across all these product lines.
The AMOLED transition. Let's unpack that because it's a perfect case study in Garmin's specific engineering moat.
It really is. So AMOLED stands for Active Matrix Organic Light Emitting Diode.
Right. It's the same incredibly bright, vibrant, high contrast screen technology you have on a premium smartphone or like an Apple Watch.
Exactly. And historically, Garmin completely avoided AMOLED on their serious endurance watches.
Right, because of the battery drain?
Yeah, they use memory in pixel or MIP displays. And MIP displays are a bit duller, they look a little washed out, but they are just incredibly power efficient.
Because if you were running a 100-mile ultramarathon or doing a full Ironman triathlon, you couldn't use an AMOLED screen. The battery would just die halfway through the race.
Right, because the pixels in an AMOLED screen generate their own light, which looks beautiful.
But absolutely devours battery life.
Exactly. So Garmin's core demographic, the hardcore and endurance athletes, they just rejected AMOLED. They valued battery life over pretty colors.
But that's changed now.
Yes. Over the last 2 years, Garmin's hardware engineers finally figured out how to heavily optimize the power draw of the AMOLED screens.
They combined it with more efficient processors and slightly larger batteries.
Yep. To the point where they can now offer a bright, beautiful AMOLED watch that still lasts 2 weeks on a single charge.
That's insane. They bridged the gap completely.
They gave the consumer the Apple Watch aesthetic with the Garmin battery life. And that just unlocked a massive wave of upgrades from their existing user base who were waiting for that exact combination.
Which brings us to, I think, the most visceral evidence of consumer demand in this entire transcript.
Oh, the Circa.
The Circa. During the Q&A portion of the call, an analyst from Morgan Stanley brought up this new product launch called the Circa. And another analyst pointed out that if you actually go to Garmin's website right now, the Circa is completely sold out.
Yeah, completely gone.
It is carrying a 5 to 8 week shipping backlog.
And Cliff Pemble even admitted the demand was, quote, definitely ahead of anything that we had imagined.
Right.
He noted that the initial registration tracking was just exceptionally strong, and they are going to be chasing back orders for a considerable amount of time.
I mean, in consumer electronics, a 2-month waitlist is almost exclusively reserved for the absolute peak hype cycle of, like, a new iPhone drop or a massively undersupplied next-generation PlayStation or Xbox.
It just doesn't happen with fitness watches.
No. So the fact that Garmin commands that kind of backlog, it proves immense pricing power. Consumers aren't just logging onto Amazon and searching for heart rate monitor and buying whatever's cheapest.
No, they want that specific Garmin device.
And they're willing to float the company their money and wait 2 months for the hardware to arrive.
But here's the thing. The hardware itself, no matter how good the AMOLED screen or the battery life is, it still represents a vulnerability.
How so?
Because a hardware advantage only lasts until a competitor in Shenzhen figures out how to reverse engineer the device, source the exact same components, and build it 30% cheaper.
Hardware is a trap if it's your only defense.
Exactly. Which is why the quietest but perhaps most consequential part of this entire earnings call was the discussion around their software acquisitions.
Yes. They are actively building a walled garden.
They really are. The transcript highlights the strategic acquisitions of 2 specific platforms, Training Peaks and Train Heroic.
And for anyone who doesn't know, Training Peaks and Train Heroic are not hardware companies.
No, not at all. They are the leading software platforms used by endurance coaches and strength coaches to prescribe workouts and analyze athletic data.
So when an analyst from JP Morgan asked how these acquisitions fit into the broader corporate strategy, Cliff Pemble's answer was incredibly revealing.
Yeah, he explicitly said they aren't looking for traditional corporate synergies. Like, they aren't just trying to cut back office costs or whatever.
Right. They are trying to build what he called a 360-degree experience.
This is the transition from selling a gadget to selling an ecosystem.
Exactly. Because if Garmin merely sells you a piece of hardware, the transaction ends at the cash register.
Right. 3 years from now, when the battery degrades, you have zero loyalty stopping you from buying a competitor's device.
But let's look at what happens when they own Training Peaks.
Oh, it changes everything.
You wake up, your Garmin watch reads your heart rate variability and your sleep data. It syncs that data silently to Training Peaks.
Right.
Your human coach, or an AI coach, looks at that data, sees you are under-recovered, and dynamically alters your planned 50-mile bike ride into like a light recovery spin.
Yep. And then that new workout is beamed directly back to your Garmin watch, which buzzes and literally tells you what to do.
You are now entirely locked in.
The switching costs just become insurmountable at that point. If you decide to buy a competitor smartwatch, you aren't just swapping out a piece of jewelry.
No, you are severing the data link with your coach.
Right. You are losing a decade of historical training logs. You are breaking the entire feedback loop of your fitness regimen.
Garmin is taking the hardware, the athlete, the data, and the coach, and wrapping them in a proprietary software moat.
It's basically the Apple playbook applied to endurance sports.
I was just thinking that. Apple doesn't just keep you with the iPhone. They keep you with iMessage, iCloud, and the seamless integration with your Mac.
Garmin is doing the exact same thing. And we actually saw this reinforced during the Q&A regarding a new AI software feature called Connect Plus Amera.
Right, the subscription layer.
Yeah, so the CEO clarified that while the base watch remains, richly featured out of the box, they are introducing a subscription layer for advanced AI-driven features.
Like highly personalized nutrition tracking and adaptive training plans.
Exactly. And Wall Street assigns a significantly higher multiple to recurring software revenue than it does to one-off hardware sales.
Because hardware revenue is lumpy and unpredictable, whereas subscription revenue is a highly predictable annuity.
Spot on. By transitioning their most dedicated users into a subscription ecosystem, Garmin is fundamentally changing the quality of their earnings.
They are ensuring that even in a quarter where maybe hardware sales dip a little, the subscription revenue provides this massive high-margin cushion.
Exactly.
Okay, let's shift our focus to the rest of the decathlon, though.
Yeah.
Because as massive as fitness is, the other segments are doing some serious heavy lifting of their own.
Yeah, definitely. Take the marine segment. It grew 14% to $341 million in Q2.
And the main catalyst mentioned in the transcript was the launch of the LiveScope 2 sonar system.
Yeah. And for the uninitiated, LiveScope fundamentally changed sport fishing.
It really did. So traditional sonar on a boat basically shoots a cone of sound down and shows you a scrolling historical image of what you already passed over, right?
Yeah, it's basically just a 2D blob of history.
Right. But LiveScope uses advanced phased array transducers to stitch together a live, real-time 3D video feed of what is in front of the boat right now.
Which is mind-blowing. Anglers can actually see their lure sinking in real time.
Wait, they can actually see the lure on the screen?
Literally. They see the lure sink, they see a specific fish react to it, and they can watch the strike happen on screen.
That feels like cheating.
Well, it's such a massive technological advantage that professional tournament fishermen essentially consider it mandatory equipment now.
Right. It's not a nice to have. It's a structural requirement to even compete. And because Garmin holds the patents on the specific ways they process that sonar data to create that live image, they command an incredible premium.
Anglers are dropping thousands of dollars to outfit their boats with multiple LiveScope screens.
Yep.
Then you have the aviation segment, which saw 8% growth to hit $269 million.
And they highlighted the new Axis integrated flight displays there.
Yeah, this tech takes the traditional chaotic cockpit with all the separate dials for navigation, communication, engine management, and weather, and integrates all of it into a single, cohesive glass touchscreen platform.
And aviation is a market protected by massive regulatory moats. Like, the FAA certification process for a new piece of avionics takes years and costs millions of dollars.
Right. A startup can't just build a cheaper flight display in a garage and sell it to Cessna tomorrow.
Exactly.
Yeah.
Garmin has spent decades building up this regulatory clearance and institutional trust.
In fact, the transcript noted that for the 11th consecutive year, Garmin was named Best Supplier of the Year by Embraer.
Right, one of the largest aerospace manufacturers in the world.
Specifically for their work on the Phenom business jets. 11 consecutive years of being the top supplier for a major aircraft manufacturer. I mean, that is a level of entrenchment that is almost impossible to disrupt.
Totally. And even the segments that appear weak on the surface are hiding incredible underlying strength.
Okay, let's talk about the outdoor segment, because revenue there actually decreased by 2% to $483 million.
Right. But here's the critical data point. Despite the revenue contraction, gross margins in the outdoor segment expanded to 69% and operating margins expanded to 34%.
Which is crazy.
They launched a new compact laser rangefinder for golf called the Approach Z10. They are selling premium outdoor adventure watches and golf tech, and they are pulling a 69% gross margin on them.
So even though sales dipped slightly, they made more money per unit.
This is the hallmark of pricing discipline. A weaker management team staring down a 2% drop in revenue would panic.
Oh, absolutely. They would slash prices, run massive discount promotions.
Yeah, they'd engage in a race to the bottom just to prop up the volume and make the top line look better for Wall Street.
But Garmin refused to do that. They held their premium pricing, accepted the slight dip in unit volume, and maximized the profitability of every single unit they did sell.
It's a conscious choice, prioritizing profit over empty volume.
All right, so that is the rearview mirror.
Yeah.
That is how they dominated Q2. But the most revealing part of an earnings call is always the forward guidance.
Definitely. It's where management is forced to put their money where their mouth is.
So based on this first half performance, CFO Doug Boson announced they are raising full year 2026 revenue expectations.
From their previous guidance of $7.9 billion up to $8.05 billion.
A $150 million upward revision in revenue guidance is a massive vote of internal confidence.
And they floated all the way down the income statement.
Let's hear it.
Full-year EPS guidance was raised from $9.35 to exactly $10 flat. Full-year gross margin estimates were bumped up by 120 basis points to 59.7%, and operating margins were raised by 150 basis points to 27%.
They are telling the market, in no uncertain terms, that the efficiency we saw in Q2 is not a fluke. It's the new baseline for the rest of the year.
The Q&A session did reveal a looming storm cloud.
Yes, it did. Several analysts zeroed in on memory chip costs.
This is a huge deal. We are in the middle of a massive global boom in artificial intelligence infrastructure right now.
Right. Every major tech company on Earth is buying up high bandwidth memory to feed their AI data centers.
And that is physically constraining the global supply of memory components and driving prices through the roof.
The CEO explicitly noted that everyone in the hardware space is facing these higher costs, and Garmin expects higher memory costs to hit their financials in the second half of the year.
Yeah, because when you build smartwatches, flight displays, and marine sonar, you are buying millions of memory chips. A spike in that commodity cost is a direct threat to the very margins we've been praising for the last 20 minutes.
Now, when I was reading the CFO's response to how they're handling this, it actually reminded me of a restaurant owner.
Back to the restaurant analogies, I love it.
Well, think about it. A restaurant owner who knows with 100% certainty that the wholesale price of beef is going to double in 3 months.
Okay.
Instead of waiting for the price hike and passing the cost on to the customer, the owner buys a massive industrial walk-in freezer and packs it to the ceiling with steaks at today's cheap prices.
Right. They lock in their cost of goods sold months in advance?
Exactly. The corporate term the CFO used was strategic inventory.
Yeah. If you dig into their balance sheet, their inventory levels increased year over year and sequentially, sitting at approximately $2 billion.
$2 billion in inventory. That is an enormous amount of capital tied up in physical components.
It is, but it was entirely intentional. They saw the AI wave coming. They saw the memory market tightening, so they bought massive quantities of memory chips at the old lower prices.
So throughout the first half of the year, they have been pulling components out of that freezer to build their products, which completely shielded them from the market price spikes.
They deferred the financial impact perfectly, but eventually the freezer empties out.
Right. They will have to go back to the market and buy memory at the new inflated rates.
And management acknowledged this reality. The back half of the year will see some margin compression as they transition to higher cost components, and that is already baked into their revised guidance.
So they aren't hiding it.
No, but the strategy they outlined to mitigate it relies on the exact same vertical integration that allowed them to weather the supply chain chaos of the pandemic.
Because Garmin owns their own factories, right?
Yeah.
They aren't outsourcing assembly to Foxconn like so many of their competitors.
Exactly. They can aggressively re-engineer their production lines, tweak their product mix, and basically find efficiencies internally to offset the external component costs.
Which perfectly transitions us into the long-term catalysts. Because Wall Street algorithms, they trade on quarter-to-quarter noise.
They absolutely do.
They will see a slight margin dip in Q3 due to memory costs and potentially panic. But a retail investor needs to look at the structural foundation being poured for 2027.
And the biggest piece of that foundation is the new manufacturing facility in Thailand.
Tell me about this, because during the Q&A, the CEO was pressed for an update on this exact expansion.
Yeah, he confirmed they are currently in the most capital-intensive phase of the project, like physically building and equipping the facility.
Right.
It is slated for completion by the end of this year, with production coming online in early 2027. And the first phase alone is 400,000 square feet.
The scale of that is staggering. I mean, management noted that this single facility has the potential to eventually double Garmin's total global manufacturing capacity.
Bubble it.
Yeah. And the critical detail is that they expect the cost structure in Thailand to be at parity with, or even slightly better than, their current global footprint.
But the strategic value here is all about geopolitical and environmental de-risking.
Explain that for me.
Well, right now, a massive concentration of global electronics manufacturing is bottlenecked in Taiwan and mainland China, right?
Right.
If there is a geopolitical escalation in the South China Sea or, a localized natural disaster, entire corporate supply chains will freeze overnight.
To totally lock up.
Yeah. So by building a massive vertically integrated facility in Thailand, Garmin is creating a redundant, cost-competitive manufacturing base. If one region goes offline, they can just shift capacity to the other.
It is an incredibly expensive insurance policy.
It is, but it makes the company structurally bulletproof in a way that fabulous hardware companies are not.
Okay, so the second major catalyst for 2027 is sitting in the auto OEM segment.
OEM meaning original equipment manufacturer.
Right. This is the division where Garmin isn't just selling a GPS you stick to your windshield. They are building the integrated infotainment and navigation systems directly into the dashboard right on the vehicle assembly line.
Yeah, but this segment only grew 1% this quarter to $172 million, and the operating margin was a razor-thin 2%.
basically breaking even.
Right. And management bluntly stated they expect this segment's revenue to actively decline and actually dip into an operating loss in the back half of 2026.
A forecasted operating loss is usually a giant red flag.
It is. But context is everything here. An analyst from Longbow Research pushed management on this exact timeline, and the CEO explained that they are hitting a scheduled air pocket.
An air pocket. Okay, so to understand the air pocket, you really have to understand automotive development cycles.
Yes.
When Garmin signs a contract with a car manufacturer, it takes 3 to 5 years to develop the system, and then it runs in the cars for a multi-year life cycle.
Right. And Garmin is currently at the tail end of a massive life cycle with BMW. The volume of those older systems being installed is peaking and beginning to wind down.
So the revenue is naturally trailing off.
Simultaneously, they are pouring heavy R&D and engineering resources into the launch of a next-generation domain controller program with Mercedes-Benz.
Okay, so the BMW revenue is falling, and the Mercedes-Benz revenue hasn't started flowing yet because the new vehicles haven't actually hit the assembly line yet.
Exactly. That gap between contracts is the air pocket.
The costs are high because they're prepping the Mercedes launch, but the revenue is low because the BMW contract is ending. It makes the Q3 and Q4 financials for that specific segment look terrible on paper.
But it is a temporary, highly predictable transition. Management was definitive that 2027 will be a year of solid growth and returning profitability for the auto OEM segment once the Mercedes-Benz program fully ramps up.
And this is exactly the danger of relying on algorithmic news bots that just scrape earnings transcripts for negative keywords.
Oh yeah, a bot will blast out a headline saying, Garmin forecasts operating losses in auto OEM, triggering a sell-off by skittish traders.
But the informed investor knows it's simply the mechanical reality of swapping out one massive automotive contract for another. So bringing this all together, when you synthesize the massive 440 basis point margin expansion, the highly favorable product mix driven by the AMOLED fitness watches, the strategic foresight of the memory chip inventory, and the massive capacity expansion coming online in Thailand. What is the actionable bottom line for the retail investor looking at this stock today?
The signal from this source material is highly bullish. The defining characteristic of Garmin right now is control.
Control.
Yes. They control their manufacturing, which shields them from outsourced supply chain shocks. They control a highly diverse product mix, meaning if consumer discretionary spending on marine toys slows down, well, the aviation and fitness segments can carry the weight.
Right.
And most importantly, they are aggressively moving to control the software ecosystem that surrounds their hardware.
With the subscriptions and acquisitions.
Exactly. The short-term headwinds regarding memory chip costs in Q3 are real, definitely, but they are a speed bump on the way to massive structural catalysts in 2027.
They aren't at the mercy of the macro environment. They are building a fortress that generates its own weather.
I love that. And that fortress is being defended by consumers who are literally willing to wait 2 months on a backlog just to get into the ecosystem. That is the definition of a deep, sustainable moat.
Incredible. Well, as we wrap up this analysis, I want to leave you with one final forward-looking thought to mull over. We spent a lot of time talking about the walled garden today.
We did.
We looked at the acquisitions of Training Peaks and Train Heroic. We looked at the rollout of the AI-driven Connect Plus subscription tier. I want you to ask yourself, are we witnessing the quiet, under-the-radar evolution of what this company fundamentally is? Are they transitioning from being a traditional hardware manufacturer, a company that just builds physical things you strap to your wrist, or bolt into a boat, into a data-driven, recurring revenue software powerhouse?
That's a great question.
Because if they are successfully making that pivot, if they are figuring out how to synthesize and monetize the daily athletic, biometric, and health data of millions of the most dedicated high-income consumers on the planet, is Wall Street still fundamentally mispricing this stock by assigning it a traditional hardware multiple?
Wow. Think about our decathlete. What happens when the decathlete decides that winning the medals isn't enough anymore and they use their winnings to just buy the entire stadium?
That is exactly the point. Keep digging into the data, keep questioning the consensus, and we will see you on the next deep dive.